Hi guys, this week I'm going to be talking about how Cineworld shareholders could get nothing, and are they going boom or are they going bust? So when I say how Cineworld shareholders could get nothing, I'm of course talking about Charlie Munger's philosophy of investing, which is try and imagine how something is going to take down your business, or if you've got a position in something, try and imagine the various things that could happen to the asset that you have, and then try and work out how the business can avoid them or what the most likely event is. So in this episode of this Cineworld series that I'm doing, I'm going to be exploring the worst possible, the incentives of everyone involved in Cineworld shares and who's incentivized to try and take down the business. So who's incentivized to punish shareholders, to try and make us get nothing? How can we sort of prepare for that? How can we understand these incentives? And the goal of this is to help you feel to see if we should feel comfortable in our position and to work out how close we are to midnight. This is a reference to The Watchmen, and it's this doomsday clock, and the closer it is to midnight, the more likely there is to be a nuclear attack. And basically, I'm using this analogy because what I want to talk about briefly before I get into more speculation and more analysis on Cineworld stock is what The Watchmen answers in response to learning about the doomsday clock. I would only agree that a symbolic clock is as nourishing to the intellect as a photo of oxygen to a drowning man. So what I take from that is if I say that Cineworld shareholders are 5% likely to get nothing, like if I say that's how unlikely it is, if I say there's only a 5% chance of us ending up with absolutely nothing, it doesn't really help you. So really, because we need to understand the events that would lead up to that happening. So that's what we're going to talk about. The only event that would cause Cineworld shareholders to get nothing, I believe, is if there was malicious intent towards Cineworld, or someone that stood to gain from taking all of our equity. And so, of course, there are a few players in this game, and we need to look at each one of them to understand what their incentives are and whether they conflict with ours. And so, first thing that I want to do is try and work out the first people that we are going to be talking about are the creditors. And so the creditors are the people that have lent us money and potentially would stand the most to gain from Cineworld going fully bankrupt, taking our equity. They potentially would gain from exchanging equity in the business for the credit. But we need to, there have been instances where banks have pushed companies into bankruptcy with the goal of taking the equity in the business. But I think this Cineworld would be a weird one for them to do. So first things first, if the banks were to do this, if the creditors were to try and take down Cineworld, there's real evidence. Like, I've got evidence later on in this video as to things they have done that I think would go against the idea that creditors are against Cineworld. But the thing is, if they were trying to take down Cineworld, they would have to try and claim that Cineworld is as small a business as possible. They would have to say that the market value of Cineworld is as small as possible. And so what I thought would be good is to again go through Cineworld's free cash flow and try and work out the value of the business, the intrinsic value of the business. It's been a long while since I've done a video like this, and I think it's really useful. You can use this to evaluate the free cash flow of other businesses. This is my special free cash flow model of Cineworld. So the first question I'm going to be asking is, what is Cineworld worth? So Cineworld shareholders, us, Cineworld are representing us, the board of directors are representing us in bankruptcy. They're going to have to try and claim that Cineworld is as big of a business as possible, even though their market cap is 30 million, 32 million, when I screenshotted my document here. They have to explain that Cineworld is worth a lot more than its market capitalization currently. And so to do that, they'll present their balance sheet, and some people do things like the value of a business is 7 times revenue, and they could potentially say that, well, our revenue is from 2019. But I think it will likely be something a bit more elaborate than that. And so welcome to my spreadsheet, and this is how I evaluate the free cash flow of a business. So the first thing I do is I go to QuickFS, and I go to Cineworld, and I go to their free cash flow page, key ratios, tab here, key ratios, and then I scroll down to free cash flow, and I take these numbers and I punch them into this spreadsheet. And in the instance of their negative year, that would actually just break my numbers a little bit. So in that instance, I put a 1 instead of a negative number, and it doesn't, I'll go into how this spreadsheet works. But basically what I've done is I've taken these numbers here, their free cash flow, and I've punched them in here. So this is how much they made after all their expenses every year running their business. And then what you do is you work out the growth between these. So this won't be exactly what Cineworld do to prove the value of their business. They'll get all their assets together and evaluation on their real estate and all of these other things. It'll be an incredibly complicated document. But for me, when I'm trying to compare thousands of companies to work out which ones I should invest in, I like to have simple formulas to try and trim them down, and this is the best thing for me to use to understand their free cash flow. And I think free cash flow models are generally the best ways to value businesses anyway. So this is their growth every year from their free cash flow. So some years it's absolutely brilliant. You've got in 2015, this is 2015 here, it was 2.27, which is remarkable. That wasn't buying Regal or anything. That was just their operating in 2015, not a special year, they made 2.27 in growth. So Cineworld have incredible free cash flow growth, which is why I got interested in it to begin with. So the next thing I do to the growth is I order it. So I put the lowest numbers all the way to the highest numbers, and this is where I want to show to you, this is the one I put in earlier. The one that I put in creates a result that is overly negative and a result that is overly positive, but thanks to doing a median, putting all the different growth numbers from all the years, sometimes it's high, sometimes it's low, I put them all in order and I take the middle 3 results. And then I create an average of those 3 to determine what Cineworld's typical growth is, because there's no really perfect way of working out how much a business grows. You've got to take some sort of average from somewhere, and this is how I do it. I like to do a median, then an average of the 3 middle numbers that I get here. And then what I do is I discount that. I take that number of that percentage of growth and I divide it, I halve it essentially, and that gives me this discounted growth. So Cineworld's discounted growth, when I discount it by half, is 1.46, which is almost 50% free cash flow growth, which is again absolutely incredible. And you can see none of these years are from the 2019. This is 2019. None of these years are from that. These aren't 2018, 19. These 3 years are taken from 2017, 2015, and 2011 or something like that, 2013. So it's not just the recent purchase of Regal which is pushing their cash flow up. Their general business generates a lot of free cash flow. So Cineworld shareholders will get to leverage that when in this imaginary event that the creditors are trying to take ownership of the business. Cineworld can say, well, look, we make an incredible amount of money. And so how do these numbers lead to sort of an actual evaluation that is devoid from market capitalization? How do we get the intrinsic value of the business? And that's why I have this slide here. Intrinsic value is basically how much cash a business is going to make from today until Judgment Day. So just to give you an idea, if you make 25 grand a year at your job, is that the best example? Maybe you take up all the years that you work at that job, and that's how much cash you've gotten from that job from now to Judgment Day. You're trying to sort of do the same thing with a business, but you're taking away capital expenditure. I think you get the idea. So I've got this discounted growth here, and I take the 2021 year free cash flow, which was 319 million, and then I times that by 1.46. Remember, this is their discounted growth. And at the end of that, you've got all of these piles of cash. You made 466 million that year, you made this much this year, this much this year, this much this year. And so obviously you're making this cash every year, which is great. And so you get to collect all that cash, you add all of that cash together. But of course, you've gotten that cash from owning the business, but at the end of the 10 years, you then get to sell the business. So we're now discounting again. Typically, you would sell the business for something like 10 times revenue. But to create another discount, to discount this once more, we're going to do it 10 times free cash flow. So this is how much free cash flow we can expect Cineworld to be making in 10 years. We times that by 10. And then we add all of this cash together. This is how much cash we've made. We've not spent it, like, this is devoid from capital expenditure. This is after we bought all the popcorn and paid for all the studios. This is how much cash we had left over after 10 years. And remember, we've discounted the growth that they got the last 10 years by half. And the growth didn't include the purchase of Regal. So this is a massively reduced amount of cash that we can expect Cineworld to make over the next 10 years, a really reduced amount of cash. And then what you do is that gives you an intrinsic value, that you take all of that cash and again you divide that by 10. All the cash that you made over 10 years, you divide that by 10. So why would you do that? Well, why would you divide this by 10? Does 10 seem like an extreme number to divide that by? Definitely not. The point is, $1 today is worth 2 tomorrow. Basically, imagine if I was to offer you £1 today or £2 in 10 years. You're going to take £1 today, right? Okay, because you know that inflation and stuff like that is going to kick the price of that pound down a hell of a lot. So we need to do an enormous discount on the cash that we're going to get in 10 years time, a big discount, because we don't know what's going to happen down the road. And so that is why we divide it by 10 and we get left with this number, which this is 18 billion, right? That is the enormously discounted amount of free cash flow you can expect from Cineworld if you hold it from now to the next 10 years. And if that sounds crazy to you, think about the fact that in 2019, the revenue of Cineworld was 3 billion. And typically, to do a general market price of a business, market capitalization is very different to what the value of a business is. If you were to try and purchase the whole thing, remember that the market capitalization is based on a tiny portion of shares that are permanently being sold on a stock exchange. The whole business is not always up for sale. If you went up to someone that owned something like a major stake in Apple, that person is not going to sell you to it at the market capitalization price. Okay, so the market capitalization price is a smaller number than what the actual market value of a business is as a whole. And so, yeah, if you were to try and work out what that is, it's probably 10 times revenue. And so that would be 30 billion, and you can see that's halved here. You got to think that things like inflation and stuff like that in 10 years' time, it's going to be 1 year's earnings is going to be a hell of a lot more than 3 billion. And you would have made all that cash getting to that point. So the intrinsic value to me, massively discounted, is 18 billion, and the debt is 7 billion. So I think Cineworld shareholders have a good amount of leverage to say that the free cash flow of Cineworld is far above the amount of credit that has been extended to them. But there's more to it than that. So yeah, let's just have a look here. This is all the sheet in one go. All of this happens automatically. This market capitalization is pulled from Yahoo Finance, so that comes in automatically. So every time I go into this Excel sheet, it is the latest price of the business. Of course, their free cash flows don't change. Just going to check if there's any comments on the YouTube video. Oh, amazing. We got Jay Sperling from Celluloid Junkies. Absolutely brilliant. I'm so glad to have him on the podcast. You should definitely check out Celluloid Junkie. Go to their site, and I'm going to be talking about that in this episode. Everything I've learned from investing, I've learned online, and I'm very open about that. I've been trading online for 8 years, and you can see my statistics on eToro. But this guy has gone into Cineworld with a fine-tooth comb. He's gone through the bankruptcy filings, and he's done 3 articles, and I've been reading all of them, and I'm going to be going into them in this episode. He's done an amazing job going into detail, like information that I hadn't found, and was really learning things. It's been a long time since I read a news article that didn't contain information I hadn't already gotten from the investor relations page of my stocks site. So yeah, this is the most valuable journalism I've read in a long time. So definitely go check out his 3 parts to Cineworld's Road to Recovery. Okay, so back to my free cash flow model on Cineworld. So what's Cineworld worth? Well, my basic free cash flow model that I've used and am constantly developing is, but always trying to keep simple, is that Cineworld's market cap versus its intrinsic value is currently sitting below 2% margin of safety, where Warren Buffett typically likes to have them below 20%. If a stock is below 20% margin of safety, that's a good value business to him. Well, Cineworld is below 2%, obviously, because this is at present a very risky thing to invest in. But that still stands to reason that Cineworld's market capitalization will be a small factor that the creditors would use if they were trying to go after our equity. The Cineworld would be able to leverage its amazing free cash flow to say, yes, that we are likely to be able to pay our debt when we're operating. So, another thing I found interesting about the creditor argument is, tell you what, I'm going to be going into that later in this video, so I'm going to leave that to later into this video. What I want to do is talk about who else could kill Cineworld and thinking about their incentives. A couple times I've seen commented that people think that Mookie would be somehow able to retain ownership of the new shares in Cineworld, and it's absolutely brilliant to have Jay in the chat, because Jay, you can tell me if I'm wrong, but this comment from one of your articles seems to imply that Mookie would not be able to retain ownership if if shareholders lost ownership to the creditors, that would mean Mookie cannot own equity in that company. And if I'm reading this right, it means other banks technically cannot also own the new shares, so that if they lose the business. So I've definitely said that wrong. What I'm trying to say is anyone that holds Cineworld shares can't get the credit and then claim ownership of the new shares in the event now that Cineworld has filed for bankruptcy. But I could be wrong, so Jay, would love you to correct me on that in the comments if that is wrong. Okay, so the next thing is the studios, and I could see an incentive for studios to want to try and take over Cineworld, and potentially they would go the route of trying to purchase the credit that Cineworld is. I mean, that's the route that they would have to do, right? They'd have to buy the credit for Cineworld, and the credit for Cineworld must be extremely expensive right now, because either you get Cineworld paying the credit back, which is an amazing situation. You'd get incredible interest on it and stuff like that, so it must be great to get the credit paid, or you get new equity in Cineworld, which is an incredibly rich free cash flow business. So potentially for the worst possible situation would be studios purchase the credit for Cineworld and then get ownership through Cineworld that way. That's I believe the only example where there is strong, like I could see strong incentive to try and take over the business that way. Going back to why I don't think the creditors are likely are going to take over the business is they've done weird things if that is their goal. If they are trying to take over Cineworld, it's certainly at every opportunity they haven't tried to screw the current shareholders over. In the middle of the pandemic, they gave Mookie emergency $200 million in funding. That's not what you do if you're trying to sort of also $200 million in funding while interest rates were incredibly low. So that's not the sort of thing you do when you're trying to take down a business. If anything, I think creditors want to support Cineworld so that they can get their money back. It's just that Cineworld have gone into a period where they just can't. There's just a drought in cinema, and they're struggling to pay these creditors. Okay, so and another reason that I don't think studios are going to be going after Cineworld is this quote here, again from Celluloid Junkie. Thank you, Jay, so much for your amazing articles. This was a quote from Lionsgate Vice Chairman Michael Burns. Cineworld filed for bankruptcy on the day that Cineworld filed for bankruptcy. I do think the studios will get paid like they usually do, whatever they're owed, because we are the suppliers, and that's usually what happens. And that's right. And also, yes, actually, I'll go back into that one. So yeah. Cineworld are very much likely to pay these guys here, the studios, because they need the product. They need the product in the cinema. They need to get these films like Amsterdam and all of that. If they don't have this product, forget the popcorn. If they don't have these, then they're not going to make any money whatsoever. And so, yeah, Cineworld are very, the top of the priority for them is paying the studios. And if they do pay the studios, it means that the studios will not be present in bankruptcy court. Basically, you only show up and have a say in bankruptcy court if you're one of the people that have not been paid. And so when Cineworld present a document that says this is what this is our plan to get out of bankruptcy, then when Cineworld present a document to get out of bankruptcy and the creditors have to vote on it, it has to be the creditors that are actually owed money. So studios won't be in there determining Cineworld's future for us. Okay, so someone asked me to comment on this Ask Traders article as well. So yeah, let's just talk about this for a minute. I put this presentation together so quickly, so I'm sorry if it feels a little bit rushed and lacking in some areas. But I don't think anyone here, the studios, Mookie, or the creditors, are adequately incentivized enough to try and take down, to try and screw over the shareholders. I think that the incentives for everyone are to get, basically just get Cineworld to a point where it's paying its creditors back. That's it. Once Cineworld are paying its creditors back, everyone wins. So I think, just looking at this, I am biased, by the way, I'm a Cineworld shareholder, but I always look at this from a point of view as incentives. That's Charlie Munger's mentality. I think he has a great sort of investing principles. He has a great way of thinking about just having, you've got to have sort of, to discipline your mind, you've got to have mental structures. And one of them is trying to work out who is incentivized to make sure that shareholders get nothing in this bankruptcy transaction. And I don't think anyone is. So the question comes down to just whether Cineworld will be able to get free cash flow back to a point where they can pay off its debt. And that's the reason this stock is so speculative, because we're all waiting for just a few films to come out in the next few months. Right, I'm just going to have a quick whiskey because I said I would do that each week, by the way. And also, I've been talking so fast, wanted to get straight into chatting about all of these different things. I get really panicky when because I was just half an hour late for this. I have got my popcorn and everything as well today, guys. I hope you do too. And I'm really excited for the new film releases that are coming out. Jay, I can't believe that you joined. I'm so grateful that you came onto this episode. What I was hoping was I could actually have you on the live stream and could ask you a few questions, because obviously you've done an incredible amount of research into the stock, a 3-part series on Celluloid Junkie that goes into incredible detail. I think it would be incredibly beneficial for my viewers to get your perspective and get your insight. So if you're willing to come again, I would absolutely be delighted to have you here on the live stream. Right, I'm going to have a quick sip and just look through the comments, see if there's any questions. Please leave your questions in this comment section, by the way. It's probably the best ways for me to get them. I'm just going to pop onto Reddit as well and see if I've got any notifications from you guys asking for any questions. And let's go to this article. Well, yes, which is... So, the US listing is currently up. US listings are currently up, which is lovely. But by the way, guys, when I see movement of 30, 50% on Cineworld, even 100%, if I saw 100% share price movement upwards, I probably wouldn't even notice it, because 3p to 6p for me, considering where my average is around 30. Basically, I need to see 1,000% to really think of it as a real movement. These price movements, even though they seem incredibly volatile, 30%, whoa, these are movements of 10 million or something like that. It's so, that amount of money in the macroeconomic environment is just not very much money. It's potential that even smaller amounts of money than that are affecting the price. So, yeah, seeing a movement of 30% doesn't really tell me a hell of a lot, unless I see a movement of around 5,000%. But yeah, great that it's up 40% in the American market, so that's great to hear. But come on, guys, we're shooting for like 10,000%. We want to get to like 10p or 30p, which would be lovely. And so, let's just go to that question let's go to that article, because I think I've got an interesting point that I could make about this Traders article. This is nice to see. It's just a bit of positivity from this guy, Simon Mugo. But what I want to say is basically this site Ask Traders, anyone can go. It looks like anyone can go on here and set up a profile. You might have to be qualified to some degree, but Simon just writes a hell of a lot of articles, and he's got 2,480 new posts. I think that's three. There's three more that he's written since I checked it up earlier today, or maybe even 7 more. This guy writes a hell of a lot of articles, and when you compare his article to the in-depth analysis that's here on Celluloid Junkie, it doesn't. Like, this is real information from someone that's read a lot of filings that you are not going to be going into. I promise. Like, if I've checked out the Cineworld bankruptcy filings, and they are incredibly intimidating documents. And in the other episode, we go through this document, the plot twist document, which is sort of a hero's journey of Cineworld. So that's good, but it doesn't tell you that sort of the information that Cineworld puts on their investor relations page. So it wasn't a hell of a lot. There's more new information in Jay Sperling's article than there was in this bankruptcy filing document here, but that was an interesting document to go through. So please go check out my other live streams if you want me to go through that with you. Okay, so guys, I think that's it from me. I really enjoyed making this episode. I enjoy doing this each week. Jay, I'm so sorry that I didn't see your message in the chat, but I hope that we can have you come actually on the episode next week, if that's something that you're willing to do. You don't have to have the camera on. I'd just love to ask you a few questions, and I'm certain that my viewers here would love to ask you questions as well. So thank you guys very much for joining me, and have a great evening. Goodbye. Alright, I don't actually know if I've ended it yet. Okay. I'm going to go onto YouTube and end it. Here we go. Right, good evening guys. See you later.